In this video, I'm going to talk about the bank failures that happened this weekend. Subscribe to Linus Wilson channel. So, some of you may know that I'm a finance professor, and I kind of studied the banking crisis of 2008 quite in detail, including the Fed emergency lending programs. So, I'm going to talk about today my thoughts on the Fed's new emergency lending program, the failure of the second and third largest banks by assets in U.S. history. First the SVB on Friday, and then Signature Bank on Sunday. I do think that some sort of government intervention, broad intervention in the banking sector, stabilizing uninsured depositors was necessary. Otherwise, we would have had many more costly bank failures that would have just been a waste, very wasteful. So I think the issue was, especially for the regional banks, was that their stock prices were going down. There was testimony about a week ago by an FDIC official who said that about a quarter of bank capital was basically, if it was mark to market, didn't exist. The issue was that there are if you have a bank account that's bigger than $250,000, then it's not insured by the FDIC. And to the extent that banks are exposed to uninsured deposits above $250,000, they could be subject to bank runs. And so the Diamond Dybvig model is kind of the classic reference about the game theory of, why you have deposit runs and why you need deposit insurance. That, if you take your money out of the bank, if it's not insured, then you pay a small transaction cost, but you potentially avoid total loss of your capital or total loss of your funds, right? And so that was kind of what happened in this particular case. That they had large uninsured deposits, large amounts of uninsured deposits at the Silicon Valley Bank, more than most other institutions. So I think somebody said they only had 7 branch banks. And so what banks basically do is they have branch banks to collect deposits from smaller depositors, but that's expensive, takes time. Silicon Valley Bank had a huge inflow of deposits during the kind of the more frothy parts of the tech sector market, starting in after the pandemic. So in around 2000. And so they went from 60 billion to over 200 billion in assets, and that was a big reason why they had to invest that money relatively quickly. Supposedly they backed it in agency mortgage-backed securities. So basically, institutions that were once sponsored by the U.S. government and kind of have an implicit guarantee from the U.S. government. So there wasn't really any risk to those investments, except there was duration risk, there was interest rate risk. And so when they made those investments, interest rates were much lower. For 14 months, the Fed has been hiking interest rates, and now those rates are underwater. So that means that the value of those bond portfolios are much less valuable. And I think a lot of banks are in that situation. So if you think of the banking industry, the old saw is that if you've got a upward sloping yield curve, the banking sector does really well. We have a very sharply negative sloping yield curve, especially last week, although it may have moderated a bit this week. That is the 2-10 spread. The 2s were yielding much more than the 10s. And we've had that situation for a while, and so you don't have that natural thing where banks are going to lend long and they take deposits which are demand short-term obligations, debt-like obligations. And so I don't know. I mean, I do find it unsavory that especially kind of VCs and VC-backed companies are essentially being guaranteed their huge deposits. But at the same time, I don't think we want to have a uninsured deposit run against all banks and flatten the regional banking sector. So I think that the Fed action, what they did was, number one, the government said that the uninsured depositors are not going to take losses at SVB and Signature, but they also said that you can borrow against your good collateral, such as agency and Treasury securities, so that if you have deposit outflows, then it's going to be for the purposes of borrowing, your borrowing is based on the par amount that you have, not the value you have. So SVB, right? So if it had treasuries at 2% and it had to sell those treasuries that are yielding that had a coupon at 2%, when treasuries are yielding closer to 4%, then they would have had to take a huge loss on that. Whereas if they just had access to the facility, which they didn't until Sunday night, they would be able to borrow money from the Fed against their good collateral, and then they could meet their deposit withdrawals. The downside, though, is these banks are going to lose money doing that, because I think I calculated the interest rate was 5.8% on the first day, right? And so if you're getting 2% on your assets and then you're borrowing at 5.8% to meet withdrawals, then that's a real problem. And I think the issue for the banking sector, regional banks writ large, is that let's pray, keep our fingers crossed that people don't start moving their uninsured deposits, or their insured deposits, even worse, into like JP Morgan Chase, Bank of America. So I think there's a table here, and it was looking at the impact of unrealized security losses on capital reserves. This is from it's from JP Morgan Asset Management. It was tweeted out by Nouriel Roubini, the professor at NYU, finance professor. So SVB had huge amounts as a percent of their capital, but Bank of America, about 50% of their capital would be wiped out if they mark to market their portfolio of loans, right? So I mean, even if they're not buying like securities, they're just making longer term loans. Longer term loans made a couple years ago are really underwater compared to what you could the bond market today. So it's just that I think we're in an issue. So I think going back to that point is that if we have people moving into Bank of America because they're worried about the regional banks, that's not actually a good thing. That's not actually that's not rational in terms of, well, what bank is better capitalized. And that's a real problem if we have the too big to fail institutions getting bigger. And I'm not sure that hopefully this stems that problem that was getting out of control over the weekend, but it potentially have not stopped that. We do not want people to be moving their deposits from one bank to the other. This facility was trying to reassure markets, and the guarantees for the depositors at Signature and at SVB, Silicon Valley Bank, is trying to calm uninsured depositors, people that have more than $250,000 in their bank account, or businesses that have more than $250,000 in your bank account. I mean, I think the general other issue is, I'm like, what kind of, I don't know. I mean, what kind of management of your company do you have that you're putting uninsured deposits in a bank versus you could be just buying treasuries and actually doing some, I don't know, of controller management, right? I mean, why not put money in treasuries, short-term treasuries, if you're putting it in the bank, and then you don't have any default risk, and you can write checks off of your brokerage account, right? I'm kind of surprised that I mean, I guess we don't want to move people to brokerage accounts versus banking accounts in terms of these transaction accounts, but I'm just kind of wonder about this whole small business or the VC argument, the argument for the individual businesses that are putting up these uninsured deposit accounts. I guess in some cases it may be unavoidable, but I don't know. I'm not sure it always is. It's also kind of like, but maybe that's the other thing, is we just don't want that move in the short term. We don't want people to move to brokerage accounts and buy treasuries in those. But I think we have this longer term issue, is that if you're a depositor and if you can get 5% from T-bills versus getting nothing from your bank, do you really want to do that, especially in a high inflation environment? And the other issues that I think that this just may have woke up a lot of people who are basically missing out on interest, and they said, maybe I need to shop around, and I don't know. I think the Fed facility, let me see if I can bring up the name of the Fed facility. We can maybe go through it. It's the Bank Term Funding Program. I think it's it helps stem the tide. It makes it less costly for bank runs, that probably the bank can survive the bank run, but it's going to be its profitability is going to be really suffering. It's going to take capital losses because their assets are not earning as much as the loans that they're borrowing. So if there are no outflows, there's no problem. But if there are continually outflows and the banks are taking advantage of this bank term funding program, which up to 1 year loans, it's 1% plus the overnight index swap for the 1 year. So I think that's the fixed rate payer rate for a 1 year interest rate swap, which is about 4.8% today. I think that it's a solution. It's just not a perfect solution. And I think the longer term thing is, why did the Fed have to do this? The Fed had to do this because they needed to create some breathing space for them to actually raise rates further. But I think we've come to the point now where we've seen that the banking system is cracking because of the raise in interest rates. And so then you kind of have the Fed that doesn't have a ton of breathing space. They're trying to create breathing space through this implicit uninsured depositor guarantee and through this explicit bank term lending program, a bank term funding program, BTFP. But I'm not sure it completely does, because you still have the problem that duration risk wasn't managed, and maybe they never are going to manage duration risk because of the nature of banking. That they're always going to be exposed to rising interest rates, and if that's the case, if the whole banking sector is, and they're never going to manage it so it's not going to be that way, then we're going to find a situation where there's a limit to how much the Fed, or how fast the Fed can raise interest rates or fight inflation through the interest rate channel, and that's a somewhat depressing prospect. Now, bank failures on their own should also reduce the amount of money supply, and to the extent that the banking system is shrinking, that would also shrink the money supply through their money creation channel. So maybe that will offset some of the fact that the Fed can't raise interest rates to keep up with inflation. I don't know. So I think they did the necessary action. Were they too late in it? Yes, they were a little late. It seemed like events were going out of control. It's a shame that Signature Bank had to fail. I don't know their whole situation. We don't like to see the second and third largest bank failures in U.S. history, and two of them were, the second and third one, which all happened this week, were caused by bank runs, which is kind of like a failure of the system. I mean, it's one thing for a bank failure to be caused by malfeasance, fraud, or just really bad quality assets, bad investment decisions. You can say that they made bad investment decisions in terms of interest rates, but then again, it's kind of hard to say that people know the path of interest rates, right? If they knew the path of interest rates, then they'd be super rich. Now, they could have just managed their portfolio so they had no interest rate risk, but I just don't think that banks actually are set up to do that. They're set up to actually be long-term lenders, and they short-term liabilities, and that's just the way banks are. And so I'm not sure that this is you can say, oh, well, the regulators failed on risk management, the banks failed on risk management. I think this might be fundamental to the banking system, and that was why the Fed had to step in, but have they gone far enough? And the other question is, I don't think the FDIC has authority essentially to guarantee uninsured deposits. And if the FDIC only has like $125 billion fund, are they going to have enough money to guarantee uninsured depositors before Congress has to step up? I kind of doubt. I don't know. I mean, I think that we have had in the past, in the savings and loan crisis, where the deposit insurance fund did have to be topped up by the U.S. Treasury. So the idea that uninsured depositors can be guaranteed without taxpayers actually paying it, only done through the monetary policy. I'm not sure that that's the case. Subscribe. I'm Linus Wilson. You can check out my research at linuswilson.com or financeprofessor.org.